Welcome back to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and today we are cracking open one of the most iconic names in American business. Episode 99, International Business Machines, IBM, Big Blue herself.
Big Blue indeed. And I have to say, Hudson, this is not the IBM your parents invested in. This is a company in the middle of a genuine reinvention, and the numbers are starting to back it up.
That is exactly right. So let's start at the beginning. IBM was incorporated in 1911, headquartered in Armonk, New York, and employs about 217,300 people worldwide. The company trades on the NYSE under ticker IBM.
IBM operates through 4 business segments: software, which includes the hybrid cloud platform and Red Hat; consulting, which handles business transformation and technology services; infrastructure, covering servers, storage, and mainframes; and financing, which provides lease and loan services to clients.
And the CEO driving this transformation is Arvind Krishna. He took the helm in April 2020 and became chairman in January 2021. He holds a PhD in electrical engineering from the University of Illinois and has been with IBM since 1990. Fun fact, he was the architect behind the $34 billion Red Hat acquisition back in 2019.
That Red Hat deal was the turning point. It shifted IBM from a legacy hardware company toward a software-centric, AI-driven enterprise platform. And now, Krishna is doubling down with 2 more major acquisitions: HashiCorp for $6.4 billion, which closed in February 2025, and Confluent for $11 billion, which just closed in March 2026.
So the question is, why IBM right now? And the answer is the AI pivot. IBM's watsonx platform is their governance and development platform for enterprise AI. Rather than competing on model size with the hyperscalers, IBM is targeting compliance, governance, and hybrid cloud deployment.
And the market is responding. Generative AI bookings have surpassed $12.5 billion, with over 80% coming from consulting services. That is real revenue, not just hype. Plus, IBM recently secured a major FedRAMP expansion, positioning watsonx as the primary alternative to hyperscaler solutions in regulated federal markets.
All right, Lana, the listeners are warmed up. Let's get into the numbers. Take it away.
Happy to. Let's start with valuation. IBM trades at $237.18 per share, giving it a market cap of roughly $222.5 billion. The trailing PE ratio is 21.0 times earnings. Forward PE drops to 17.7 times. Price to book is 6.8 times. EV to EBITDA sits at 16.0 times. And here is the eye catcher. The PEG ratio is just a 0.63.
0.63, that is well below 1.0, which traditionally signals undervaluation relative to growth. That seems cheap for a company growing earnings at this clip.
It does stand out. Now let's look at income and growth. Full year 2025 revenue came in at $67.5 billion, up 7.6% year over year. That is a meaningful acceleration from the low single-digit growth IBM posted for years. Quarterly revenue in Q4 2025 was $19.7 billion, the strongest quarter by far.
And on earnings?
Trailing 12-month EPS is $11.15, reflecting 33% growth year over year. Gross margin is an impressive 58.8%. Operating margin is 17.3%, and net margin is 15.7%.
Nearly 59% gross margin on a $67 billion revenue base. That software mix shift is clearly showing up in the numbers.
Exactly. The more IBM shifts towards software and away from lower margin infrastructure, the wider those margins get. Now, cash flow. Free cash flow for fiscal 2025 was $12.3 billion, with an FCF yield of 4.2%. That is a healthy cash generation machine.
How does the free cash flow trend look over time?
Improving. Free cash flow was $8.5 billion in 2022, $12.1 billion in 2023, $11.8 billion in 2024, and $12.3 billion in 2025. The dip in 2024 was minor and largely tied to acquisition-related cash outlays for HashiCorp.
Solid trajectory. What about the balance sheet?
This is where it gets more complicated. Total debt is $67.2 billion. Net debt is $53.5 billion. Debt to equity is 2.06 times, and debt to EBITDA is 3.1 times. The current ratio is 0.93, which is below 1.0, meaning current liabilities slightly exceed current assets.
That debt load is not trivial. $67 billion is a big number.
It is, but context matters. IBM generates over $13 billion in operating cash flow annually, and the debt-to-EBITDA ratio of 3.1 times, while elevated, is manageable for a company with IBM's cash generation profile. They are actively deleveraging. Total debt declined in Q4 as they paid down over $5 billion.
Good to hear they are chipping away at it. What about dividends?
IBM yields 2.83%, paying $6.72 per share annually. The dividend streak is 29 consecutive years of payments. The payout ratio is 59%, which is sustainable given the free cash flow. However, the 5-year dividend growth rate is just 1.2%, so income investors should not expect rapid dividend increases.
A nearly 3% yield with a sub-60% payout ratio. Not bad for a tech stock.
Overall, IBM's financial health is solid. Revenue growth is accelerating, margins are expanding with the software mix shift, and free cash flow is strong. The debt load is the main watch item, but the company is generating enough cash to service it while continuing to invest in AI and acquisitions.
All right, let's talk about what Wall Street thinks. The analyst consensus is moderate buy, with about 15 analysts covering the stock. The median 12-month price target is around $280, implying roughly 18% upside from the current price of $237.
The notable recent moves: UBS upgraded IBM from sell to neutral in February 2026. That is significant because UBS was one of the most vocal bears on the stock. Jefferies upgraded from hold to buy in January 2026. BofA Securities, Stifel, and RBC Capital all maintain buy or outperform ratings.
So the bears are capitulating. What about insider activity?
Net insider buying of about $417,000 across 3 transactions in the last 90 days. Director David Farr purchased $304,000 in open market buys as the stock declined 22% from its all-time high. No notable insider selling.
Insiders buying on the dip, always a good signal. And what about the most recent earnings?
Q4 2025 reported January 28, 2026. IBM beat on both lines. Revenue came in at $19.7 billion versus the $19.2 billion estimate. That is 12% growth year over year. EPS was $4.52 versus the $4.31 consensus.
A clean beat. What drove it?
Infrastructure revenues surged 21% to $5.1 billion, driven by Z Systems mainframes, which were up 67% year over year. Software revenue grew 14%. Consulting was the laggard, growing in the low single digits.
And what did management guide for 2026?
Revenue growth above 5% at constant currency. Free cash flow target of $15.7 billion, which is up $1 billion from 2025. And operating pre-tax margin expansion of roughly 100 basis points.
All right, let's lay out the bull case. Number 1, enterprise AI adoption is accelerating. AI bookings have surpassed $12.5 billion, and we are moving from the experimentation phase into scaled production deployments across banking, healthcare, government, and manufacturing.
Number 2, Red Hat is a genuine growth engine. Software revenue is growing at mid-teens. Red Hat OpenShift has $1.7 billion in annual recurring revenue, and it is becoming the enterprise Kubernetes standard for roughly 4,000 clients globally.
Number 3, the acquisition strategy is building a platform. HashiCorp adds infrastructure as code with Terraform. Confluent adds real-time data streaming with Apache Kafka. Combined with Red Hat and watsonx, IBM is assembling an end-to-end hybrid cloud and AI platform.
And number 4, regulated markets are a growing tailwind. FedRAMP approval opens the door to over $1 trillion in federal and regulated sector total addressable market. Sovereign cloud initiatives in Europe and Asia create additional greenfield opportunity.
Now the bear case, and we have to be honest here. Number 1, AI could eat IBM's own consulting business. In February 2026, IBM stock dropped 13% in a single session on fears that generative AI tools could automate COBOL modernization, which is one of IBM's high-margin consulting niches.
That is a real concern. If AI agents can do what IBM consultants do today, the consulting segment faces structural margin pressure. And remember, over 80% of those $12.5 billion in AI bookings flow through consulting, the lower margin side of the business.
Number 2, hyperscaler competition is fierce. AWS Azure and Google Cloud bundle managed Kubernetes, data services, and AI platforms at aggressive pricing. They have more compute, more data, and more developer mindshare.
Number 3, the debt load. $67 billion in total debt after the acquisition spree. That is roughly 45% of total assets. In a higher-for-longer interest rate environment, debt service could constrain investment in quantum computing and AI research.
And number 4, the current ratio is below 1.0 at 0.93. That signals tight short-term liquidity, which becomes a risk if we see any macro downturn or credit market stress.
Those are all fair concerns. The bull-bear tension here really comes down to execution. Can IBM monetize AI through software faster than AI disrupts its consulting revenue?
Perfect segue into the peer comparison. Let's stack IBM up against 3 key competitors. First, Accenture, ticker ACN. Accenture trades at a PE of about 22.5 times with revenue growth of around 5% and a net margin of roughly 15%.
IBM's PE of 21 is slightly cheaper than Accenture, with faster revenue growth at 7.6%. But Accenture is a pure consulting play, so the comparison is most relevant to IBM's consulting segment.
Next, SAP, ticker SAP. SAP trades at a premium PE of about 35 times with revenue growth around 10% and margins around 22%.
SAP's higher multiple reflects its pure enterprise software positioning and higher growth rate. IBM is cheaper, but SAP's cloud transition is further along. If IBM's software mix continues to shift higher, that valuation gap could narrow.
And finally, Cisco, ticker CSCO. Cisco trades at about 18 times earnings with revenue growth of around 3% and a net margin of about 26%.
Cisco is the value play in this group, cheaper than IBM on PE, but growing slower. Cisco's higher net margin reflects its mature networking-focused business. IBM has more growth optionality through AI and hybrid cloud, which justifies the modest premium.
So the bottom line on IBM, this is a 113-year-old company in the middle of its most significant transformation since the mainframe era. Revenue is accelerating, margins are expanding, the AI bookings pipeline is real, and the stock is trading well below its 52-week high.
The single most important number for investors to watch going forward is the software revenue growth rate. If IBM can sustain mid-teens growth in software while managing the consulting transition, the stock re-rates higher. If consulting deteriorates faster than software accelerates, the thesis is in trouble.
Well said, and we will leave you with a quote. Arvind Krishna, IBM CEO, said at IBM Think 2025, "The era of AI experimentation is over. AI has moved from experimentation to unlocking business value."
That is exactly the narrative IBM needs to deliver on. Less experimentation, more execution.
If you are new here, Charged Alpha is your stock-by-stock encyclopedia for the S&P 500. We break down one company per episode. No opinions, no hype, just the facts. Hit subscribe so you do not miss the next deep dive.
And remember, nothing in this episode is financial advice. We are here to educate, not to tell you what to buy or sell. Always do your own research and consult a licensed financial advisor before making investment decisions.
That's our deep dive on international business machines. Big Blue, reinventing herself one more time.
And somehow still paying a nearly 3% dividend while she does it.
This is Charged Alpha, the S&P 500 stock encyclopedia.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.